Good afternoon, everyone. Welcome to the next in the series of Black Sun webinars. As I wait for everybody to join, as usual, what I'm going to do is I'm going to launch a bit of a poll for you all to fill out as we're waiting for people to join, if that's okay. I'm so happy that there's so many of you engaging with us over this series of webinars that we've been doing. Just to set the scene today, as always, we'll try to make it as interactive as possible. There's a Q&A function on the screen, so please use that and put in as many questions as you'd like. That would be great to keep the conversation going. It is going to be a conversation that we're having today, so we will be following a Q&A format. I've got a couple of polling questions that I will launch throughout the series to set the scene. But as I said, we'll try to keep it as interactive as possible. So again, welcome to all of you that are joining. We're expecting quite a lot of people on the phone, so I'm just going to give it a couple more minutes. And just to let you know, this is the third of a series of 4 webinars that we're doing to launch our research into the trends in reporting of the FTSE 100. This year, our research is called Rewiring the Ecosystem for Resilience. And we really are calling for companies to rethink and rewire to rebuild for resilience in the future. The first 2 of our webinars, if you missed them, went through our research in detail. We set out our 6 principles of trust in the first one, and then the building blocks of reporting in the second one. They are available on demand on our website if you'd like to have a look, or if you'd like to talk to us about any of the research, we'd be delighted to talk you through it. Today, I'm going to be in conversation with Sasha and Mirza. I'm super excited about this conversation, and I really want to find out investors' expectations for the future, and also really to get some advice for you corporates and for your boards in terms of how to communicate more effectively to investors and your wider stakeholders. And then the 4th webinar in our series will take place next week. Again, I'm super excited about that. That will again be a conversation that we'll be having. We're having Ben Matthews, Company Secretary at BP, as well as Carla Bloom, the IR Director at Brewin Dolphin, who was previously at Vodafone for 8 years. We had a briefing call this morning, and I think some of the things that we talked about in that call, I'm sure we'll pick up on this one. But I was really excited talking about how do you drive purpose right through to performance, looking at ESG as a business imperative, the importance of reporting and communications as a driver of change, and then of course the changing conversation with investors and how to adapt to that. So super excited about all of that. So I hope you do join us for that, that session as well. Just a little bit about us for those of you that don't know us. Black Sun, we help businesses to communicate authentically how they deliver value to their different stakeholders. We know from our experience that communications and reporting can really drive change and drive long-term sustainable performance through that process, both internally and externally with stakeholders. And we do it with multiple stakeholders as well as through multiple channels. So that's what we do. when we started our research 15 years ago, we talked about reporting as an obligation, and you could use it as an opportunity. I think we're now in the stage where you need to obviously use it as an opportunity, but I think it's more than ever an obligation to really demonstrate what you're doing about a lot of these issues. So just really to set the scene, I think in terms of some of the questions, and thank you for answering it, we've got many of you that feel that your current reporting isn't quite meeting the information needs of your investors. And you're also often being asked about ESG issues with investors. 80% of you are often coming up in conversation. And I think from the next one, to what extent ESG factors are integrated into your long-term value creation story, a lot of you are struggling with that. So I'm hoping that we'll be able to pick up on some of those questions today with both Sasha and Mirza. So what I'm going to do is I'm going to pass over to Sasha and then Mirza to introduce themselves, a little bit of background, and really what their focus is at the moment. So Sasha, can I ask you to start off for us? You're on mute, Sasha. Sorry.
I did that on purpose, Sally. I did that on purpose. Who would make such a schoolboy error at the beginning of a call, eh? Good afternoon, everyone. Annual reports, investors, they go hand in hand. This is a really important subject. There is so much discussion at the moment. I mean, I saw some of the comments on the ESG polling you've just done. You know, it wasn't that long ago that it was, oh, it's very rare we get asked these kinds of questions, or it's very rare. And now we're getting asked all the time. Companies are getting asked this. And I think how they explain it is going to be very, very important. And obviously annual reports are a very big beast. We all discuss about how many pages there are, but there are some amazing nuggets in there, and investors do use those nuggets. Investors use them in the good times, but they certainly use them in the bad times. And I think that there is no one size fits all. So you might say, how many people read the annual report cover to cover? I would say that might be quite a few, or not many. But I tell you what, people will read certain sections of your annual report and they'll look at them. And I know Mirza will speak for himself, but we certainly speak that we look at certain parts of it. When we meet all the chairmen and the boards that we do, we will certainly look at specific sections, and we compare that with what other rivals talk about. And it does give you a good reflection of what we're trying to look for. And it's a great starting point in a discussion document. It's the one place where it's consistent, or it should be. It's a place that you have to do. It's a place you can't pull it after a year or put it on a website and take it away. So I think that's always important. And I think as an investor, I mean, an investor again is just a broad range. But whether you're an index investor, equity investor, credit investor, you are looking at different things and you are trying to get some information out there. But I have to say, with the amount of data out there and the amount of soft data that is coming out from other sources, it's sometimes a really good rock to anchor everything, to come back to a place where you can control the narrative. If I'm a corporate, you can't control some of the narratives out there, and some of the things that ESG providers are trying to sell to us as investors are always trying to tell us this is better information, or they're using natural learning processes, NLP, AI, they're using all these sort of chain names, and I don't understand half of them. But you control the narrative of the annual report. You can always say to us, go to page 74, this is what we believe in, this is our view on diversity, or this is our view on tax. I won't go into any of the detail now, but it's very important. And I think as the proliferation occurs, having one place where we can still see things and it's written by you is a really important document.
Super. Well, that's a super start. I'm glad that you do read the annual report. Mirza, what about you? Do you actually read the annual report? And can you share with us why you think they are important?
Sure. Good afternoon. And it might have been easier for me to wear my I agree with Sasha t-shirt because I'm going to echo a number of points that Sasha mentioned. So, I mean, we as an institution do refer to the annual report, and it is really welcome the conversation about creating a mutual understanding as to why investors read the annual report, because sometimes you can get lost in the breadth of the target audience from the annual report. So I'm pleased that we have the opportunity to really sort of hone in on what interests us and what drives us to look at it. I mean, from an investor perspective, we have the opportunity to invest in tens of thousands of companies globally, literally. And the annual report is a shop window. It's an opportunity for companies to communicate and sell the investment opportunity associated with the business. And through the course of the discussion, we'll get into specific areas of interest. But it's important to keep in mind the building blocks that, in effect, make up that investment case. So not an exhaustive list, but we would look to try and understand the industry trends that have given rise to the business opportunity that the company is looking to target. We would try and get a sense of the leadership team, both the management and the board, to sort of justify our confidence that we would trust them with our money. We would look to get a sense as to what the competitive advantage and differentiation that the business has, and what assets, financial and non-financial, that companies can lean on to deliver on that strategy. As investors, we would want to know what the outcomes that we can expect if strategy is delivered, both financial and non-financial. We'd want to know about the risks, and we'd want to know the story so far. So, I mean, the company should be looking at the annual report as an opportunity to explicitly and implicitly build investor confidence in the long-term story and health of the business.
Mirza, I mean, that's excellent. I want to wear a t-shirt just like you as well, because I agree with everything you said in terms of the building blocks. And actually, when we've looked at our research over the past few years, we talk about those building blocks as telling the long-term value creation story and how to articulate that to investors. And then the other things that we've talked about recently, which I'd just like to test on you, is what we call our 6 principles of trust. And those are sort of the themes that we feel almost sit on top of that kind of permeate across any organization. And those are purpose and culture, cognitive diversity, stakeholder engagement, and long-term thinking, those sorts of things. And we believe that individually and collectively, they contribute to building trust, corporate trust, and are critical in forging strong relationships with key stakeholders. And we kind of believe that they'll be more important in the future. And I guess the question for you is, how important are those principles of trust to you? And if they are, which one resonates the most with you? I go to Mirza first, and then maybe Sasha.
Sure. I mean, if you think about investment, it's about delegation, and delegation is about trust. So savers would delegate to trustees, trustees would delegate to us as asset managers, and when we invest, we're effectively delegating assets for utilization by companies to deliver the investment outcomes that our clients need. And given that framework, the extent to which we trust a business, trust its leadership, is absolutely critical in determining whether we are willing to and prepared to invest or not. And I mean, if I think through the principles that you mentioned, I think all of them are absolutely central components to a relationship of trust. They are interdependent to some extent, so it's difficult to pick out one. If I was to pick out one, it would probably be the responsible business part of it, because that I more closely associate with action, and sort of action is the manifestation of all of the other principles. So responsible conduct is a reflection of a positive and progressive corporate culture, and the reverse is always true. And with businesses, and like all of us, we are judged first and foremost on our actions before just what we say.
And Sasha, would that be the same for you?
No, I'm going to completely disagree with Mirza.
Okay.
But I mean, you can't have those 6 things, and of course they're important. They're all important, of course they are. I mean, the one that, I mean, if I had to pick one, I think back to culture. Only, and again, it's slightly for different reasons, but the same thing. I was asked to do a panel and a session when I was younger, and part of being an active fund manager, an equity fund manager, and you had to work with the CIA, an ex-CIA colleague who was there to try and how you can spot people who are lying or what they're doing and all of that sort of stuff. And one of the things that came out was culture is what you do when no one's looking. And I think, no one's looking, and I think that's a really good way of trying to put it through in culture. But culture for the business is back to trust, and that's one of your 6 principles. Obviously, is there. You have to know, how is that company going to behave? And there's nothing like, and I think sometimes corporates should do this, nothing like, and I'm sure Mirza's had it, but you go to a trustee meeting and you meet the people whose money it is, or the asset owners, and you meet them with their money, and they're really upset when they see some of the scandals in their companies that are in their portfolio, or they're really upset when they see that there's a lack of diversity, or some of the things, or they don't think there's enough pace on inequality, or whatever it is. That's why we push as investors, because we are getting not just pushed, it's someone is going, I've given you my money, I don't understand why you've done the things that you've done. Now, the first answer is, you're going to make mistakes. We all do. It's bloody hard out there in the world, and it's very hard at the moment. But that's not what this is. It's what did you do and how did you do it? And if you made some mistakes, fine, fess up, and what you're going to do to do it better next time. And if you give that, then you build that trust, which is back to your point. If you build that trust, then you will be allowed, quite rightly, to make mistakes. And we understand capital is there to make mistakes, but it's about whether people believe that you're doing it for the right reasons. And that's the problem sometimes. There's some really good companies there that make some really silly mistakes, and it ends up them having a big vote against an AGM or something like that. And you sit there going, that's a good company. It's a real shame they did that. We know which ones are some of the poorer ones, but that company has made some basic errors, and the annual report can be a way of helping manage that.
Okay, I mean, I think that's super helpful advice. And just to dig a little bit deeper in that, Sasha, in terms of reporting, I guess, helping to create a better conversation and dialogue with investors and wider stakeholders, is there any examples that either Mirza or Sasha, you could give specifically, share with the audience that you've seen that take place in terms of companies having to report or communicate on something, and how that's driven change internally?
Well, I'll start with one, give you a bit of time, just it wasn't planned, but I remember Petrofac had a lot of problems in the past, and it had a lot of problems for lots of reasons, which we won't go into now. But reading the chairman's statement, that chairman felt it. He'd written that statement, which is always a first tick. But secondly, you'd felt the humility. They'd made a mistake. They were going to put it right. They'd put all their pound of flesh in, and whether they get it right or not, you just felt that that company was trying to do the right things, and that felt good. Whereas there are other companies you've seen, certain banks after the crisis, that you'd read their statement, you think, did they just go through a financial crisis? Did they just need Elgin and Aviva and others to bail them out? And that those were the bailed out, not the government ones. But it doesn't feel like that. I can't really read that. I can't feel that they were involved in that. And so the difference between those two is definitely tangible. And then when you are then asked for either money, equity, or whether you're asked for a vote or support or other things, you are definitely going to give one more the benefit of the doubt than the other.
That's helpful. And Mirza, do you have any examples, specific or general?
Yeah, I mean, and to be honest, I think there is a natural relationship between disclosure, accountability, and behaviour. So, I mean, we could probably point to a number of examples. I mean, keeping on the broad sector that Sasha mentioned. I mean, if you look at safety data, I remember when safety data was all very positive, but it was narrowly restricted to employees. And then I remember talking with a few companies within the extractive sector, and the topic of contractors came up. And that wasn't in scope, but what we found out was that there was a substantive divergence in the quality of safety standards, whether that's fatalities, near misses, or accidents and injuries within that community. And I think as conversations matured, there was much greater scrutiny on this. Data was reported, and that fundamentally changed the entire behaviours, responsibility and accountability of the sector. There's a much greater convergence now between safety standards amongst the employee community and that of the contractor community. So, I mean, I think it's a tried and tested road where you start with disclosure. That's where you identify where the problems are. It's also where you can set ambition over the long term. And then that is the sort of reference point for future dialogue and progress over time. So I think while you don't want to replicate exactly a one-to-one model on every issue, I think it does give a good framework, whether that's diversity or other broader sustainability issues.
Just intercontinental hotels on board evaluation. You really feel, I mean, I look at companies and with my team and stuff, and you look at that and you read it and you go, right, they've had a proper board evaluation. They've had literally a task of what they wanted to get out of it. Then they've said what they're going to do, and they've said what they did from the last year. And then you go to that, and then you go to X PLC, and they go, we did a board evaluation and we all function effectively. And you go, the difference between that is huge. And already that just gives you, again, I've got questions for Intercontinental because they've given me some questions to ask because there's things they need to improve and things they're going to do. But the other company that says they function effectively, well, no one can support, no one can change. I mean, there must be something if all of us could do a bit better, especially in any walk of life.
Okay, super. I wanted to dive a bit deeper into that because one of the things that we've seen a lot of reporting on is Section 172 and stakeholder engagement. Sorry, I've got my dog barking in the background.
Does your dog bark when you say Section 172?
Exactly, trying to do that. Exactly. And one of the things we noticed about reporting anyway, and I like this idea, your linkage, Mirza, between disclosure, accountability, and behavior, because that's exactly the process that we see happening with our clients and other corporates. So what we found this year is a lot of companies reporting much more broadly on stakeholders, but the challenge was there's not that many of them actually describing how stakeholders have been considered in any decision making or how they've been considered in strategy. So really very few giving real insight around those things. And I know, Mirza, when we talked before, you had quite an interesting view on the stakeholder model, and I wondered if you wanted to kick it off and share that with us now.
Yeah, sure. So, I mean, this is a conversation we have with the companies where, I mean, the first point is that they ask what should we report and where, and what the boundary should be. And it typically translates into a Section 172 part of the annual report. And the question that I have is, I try and ask companies to reflect on where the profit motive is reflected in the business, whether that's on the strategy side, management side, or reporting side. And the truth is, it comes as no surprise, that the profit motive is fundamentally embedded in every single aspect of the business, as you'd expect, whether that's strategy, appointment of senior leadership, budgeting, investments, reporting and risk controls. And if we're genuinely saying that a business is moving to a multi-stakeholder model as a complementary or dual goal with profit, then in the same way that type of thinking should be embedded, shaping, coloring and defining every aspect of the business. So I mean, just to give you one simple example, appointment of senior leadership. So it's very, very normal for a nomination committee to say, well, what has this individual delivered in terms of successful, profitable companies in the past, and does that translate into their new role? There was one company that I've seen that actually framed the qualifications of their newly appointed CEO by referring to their experience of leading purposeful brands. And that was an important consideration in why they were considered the best candidate for the role. So I mean, that's the exception rather than the rule, but it's an example of where the stakeholder sort of considerations need to be reflected throughout every single decision that takes place across the business.
I think Section 172 is absolutely one. It's not new. It's not new. I think it was Robert Swannell who put up a slide at an event, and he put in that we should always take account of our employees, our suppliers, and most importantly, our customers. And it was M&S from 1956. You know, some of this stuff is not new news, but how you do that is what's new news. People aren't just going to take that. So I think the one that's going to be absolutely up there, we're talking about Section 172. First of all, we're going to talk about COVID, of course we are, but what have you know, I think Mark Carney said it at The Economist 4 weeks ago. We're going to look back. This was a war. What did you do in the war? And your actions will be judged. And they'll be judged by not just investors, they'll be judged by your employees, they'll be judged by the media, they'll be judged by the government, they'll be judged by the regulators. So show what you've done. This will be your perfect example to show what you meant by Section 172 or looking after stakeholders. And some companies, the good news is, I've seen many, many, many good examples of it. But boy, please make sure you put some of those tangible things in your annual report, because I think you will be judged on it. And then we'll start talking about another debate later, will be ethnicity. That will be another one that people will talk about. And I think that's going to be, again, we know that most companies don't have great ethnicity. That's fine, because that's where you are. But what are you going to do about it, or how are you thinking about this? And that all comes back to the other point. So Section 172 is there.
I think that's a really, really important point to remember. And I think your point about what did you do, but also what you're going to be judged by what companies did not do, I think is the other thing.
Absolutely.
Is moving forward, which is interesting. Now,
so
look,
just on that, Sally, just one point that Mirza touched on, which I liked as well. I mean, I've seen when at our board at Elgin, we appoint at every board meeting a client representative, someone who's at that board meeting just thinking of what's right for the client. Now, we should all do that as a director all the time, absolutely. But we specifically focus it, just like companies now have an employee representative. And I think it's a really good test to try and say, right, let's think of it. And I know Mirza mentioned it from a profit motive, absolutely right. Think about it. And then those actions or things that you think, that's the things you should be reporting on, what you did at the board meetings, what you thought were important.
Okay, I would agree with that. And just let's dive a little bit deeper on, I mean, we've been skirting around the issues around ESG, which are clearly becoming more and more important. And it would be really great. A lot of the questions that we're getting from clients and corporates is, what would investors like to see from companies during this crisis? What's the balance of E, S, and G? And is S more important moving forward? Can you just give us a little bit of color in terms of what are you looking for now, but more importantly, what are you looking for in the long term? Or maybe they're the same thing. Mirza, do you want to kick off on that one?
Yeah, sure. So, I mean, a lot of investors are characterized as optimistic, but we're realists. We are acutely aware of what's happening in the economy, where GDP is likely to be this year, where it's likely to be next year. And we are fully cognizant that it's going to have an impact on company profitability and margins and their bottom line. And therefore, what's going to make us stick by a company during this crisis is not whether they limit the earnings downside to 10% rather than 12%. It's how strongly they are positioned to capitalize on the growth opportunities that come when we are finally ready to recover as an economy. And I think where a lot of companies have gone wrong is beyond just near-term survival, which is understandable. I think that there has been an immediate tendency to focus on very short-term issues, squeeze employees, squeeze suppliers, cut employees, or restructure employment contracts, which would make the firm less attractive in the future, to overly gear their balance sheet, effectively weaken the business for when the economy recovers. And that's the company that we would have red flags on. It would also raise question marks over the authenticity of their corporate culture, and some of the commitments that they made in the good times, when it's very, very easy to make commitments in the good times. It's the crisis period that those principles are actually challenged. And if you fail that challenge and fail that test, it's very difficult to rebuild confidence and trust when the economy starts flowing again. So that's really what we're looking for companies to have a long-term picture. We don't mind if there is a near-term hit on profitability. We would rather companies do the right thing, make sure that they are seen as winners from a stakeholder perspective, rather than a near-term profitability perspective. And then we are more likely to sail with them on that journey as the economy recovers, like I said.
Okay.
And so one final point, we're not big fans of symbolic gestures. So companies were cutting executive pay for 3 months, and then everything's back to normal for them, when clearly we are far from normality in the broader economy. So companies need to stay clear of gestures, because that doesn't compensate for real action, and investors, like all other stakeholders, can see through it quite quickly.
Okay.
I think Mercer's more cynical than I am, because I used to be more of an equity investor, but more cynical than Mercer are credit investors. They just want to know about downside risk, and they just want to know about what could go wrong, and they're paranoid. And I think they read an annual report in a very different way to an equity investor, and different to an ESG or a governance specialist. So if you think about some of the things at the moment, I mean, let's look at what we're going to say. Just think of it as an investor point of view. We have many times, we've had crisis, maybe not one like this, but we've had many crises. And the way that companies react to this is normally how they make money, or they perform, or they have their value for the next decade. And so I think it's really important, and it's touching on what Mercer said, if you were to invest now, whether it's not reduce staff as much, maybe, you have to do what you have to do, but maybe you go to 12% down, not 10%, because you keep those extra people that just you think are going to be better for when the V shape or W shape or whatever shape is going to come back. The fact that you might keep training your staff, that you keep those things, they're the things that are going to give you the value add when you come out of this. And explaining that and why you've done that is going to be the way that you will differentiate yourself and get an investor like Mercer on board, than have another company who said, well, I didn't go down as much as everyone else. Yeah, but you've got nothing left in the tank. You've not just got rid of the fat, you've got rid of the muscle. And I think that's what people are trying to look for at the moment. Which companies have understood that and put themselves in that place? And I think you can explain that story in the report and accounts. And it's not all about, like I said, it's not all about just profit stuff, but it might be the training budget didn't go down that much, or it went down for a period of time, but we understand that we've got to do that, or we've worked out different ways of doing these things. But R&D, we still care about R&D. I mean, why else do you invest in companies if they're not investing in themselves? No point giving them £1 and asking for 90p back. It's not a very good return. You want them to take that £1 and invest it, and then give you back £1.50 over the next 5-10 years. So those are the things that you can definitely do. And those metrics are ESG. Now, we've talked about ESG, and it's sort of seen as all new, but it's not new. It's all about how you run your company. And I think it's really important that we say, if you think these are the 3 most important metrics well then show us. And your chairman should have it in their slide pack that's linked with the CEO's slide pack, which is linked to the annual report, and use the same metrics. And if you're even good, maybe put them in your pay structures.
Okay, super advice. Now I'm going to do two things right now. There's a couple of good questions coming up that I want to ask to both of you, and then I'm also going to launch, just because of what you just said, Sasha, I'm going to launch our second poll, which is really around what you were picking up on in terms of the board and how involved they are in some of these decision makings, and how importantly do they see ESG. So the question I've got here, which I think is a really good one, is how do you factor in the investments that companies have made during the COVID pandemic that have not had a positive effect on revenue, and in many cases have had a negative effect on revenue? So the example here being those companies that have diverted resources to supplying PPE or made significant social investments. So that's the one, I think, very specific question. And then another question from another attendee is, how do you quantify the importance of competing stakeholder interests? Do you measure or inquire about the ROI of what companies spend on any given stakeholder engagement or value creation activity? So I think they're looking to see if you're looking for quantifiable measures in both of these things. Mirza, do you want to start on that one?
Yeah, so it's I mean, just to give you a couple of examples of where it went well, and where we were willing to support a company because of the positive actions that they'd taken during the COVID crisis. So one was a healthcare company, that private healthcare, we'll call it voluntarily, but it gave up its facilities to support the NHS during the peak of the infections. And we remembered that. And when it came to their AGM, and we were asked to support somewhat contentious proposals, we ended up leaning in support of the company, in recognition of the good faith and trust that was built during the crisis. Whereas in other companies or other years, it more than likely would have got a vote against from us. So we definitely log, recall, and refer back to positive behaviors, and obviously the reverse on the negative side. The other one was, I haven't been naming companies, but given it's a positive story, BT. So I mean, we've got a reasonable position in the company. You'll all be aware that they took a fairly extreme position of significantly cutting the dividend over the near and medium term. That obviously had an impact on the investment case, on valuations. But they came to the market and they outlined their sort of strategic roadmap for growth. But as part of that, we held extensive conversations about how they treated their employees during this period. And as part of that, they paused on any headcount reduction, which had been in the plan for a long time. It would have been very easy for them to simply just say, oh, we already planned it, so we're going to execute it. They paused it, and then for frontline staff, they actually paid them a bonus because of the challenging environment that they were expecting staff to operate in. So I mean, that is a real positive story of a company that is going through a transition, but during that transition behaved admirably during the lockdown period, and as a result of that, it did strengthen our trust and confidence and willingness to be patient with the management team, even if it meant our short-term cash returns from the business were depleted. So I mean, those are the couple of examples on the positive side.
Yeah, I mean, the question about how do you quantify competing stakeholder interests? Well, I don't think it's, for a start, I don't think it's that important to us. As in, if you think your employees are very important, then you should be absolutely looking at their interests, and I'm sure the employees will tell you what they think about your own company. They do in my firm, that's for sure. And I think it's really important that you are not just listening, you are, because they understand what's really going on in a company. They've always been the same as the pension fund trustees. They know more about the company than most investors. So I think it's important that you're doing that for the reasons that you want to do it, that it's important. And then you use other ones, like you talk about your suppliers. Well, certain suppliers in certain industries are crucial to the quality of your product. And therefore it's absolutely, you should be spending a lot of time on that, because, you know, we've seen with some of the house builders when the quality of the product was poor, and they've now been completely challenged on that. And now they've completely changed the management team of those house builders, and Persimmon being one of them, and has to change that because the product wasn't good enough. Now that's pretty damning for a house builder not to have a good house. That's what it makes. That's the whole point of it. And now it's spending a lot of time, and one of the metrics is about how do they feel that customers 6 weeks after the house is built and moved in feel about that product. So, I mean, I don't know what the ROI is on that, but it's absolutely key, certainly key to the quality and the sustainability of that company.
Super. Can I, one of the issues that's coming up a lot, and I know the FRC is really pushing, is this idea of purpose. And the purpose of companies moving forward. And there's a couple of questions from the attendees around purpose and what your thoughts are on purpose and effective linkages to company strategy, or do you expect companies to report more on purpose in relation to COVID going forward? And I guess the debate we often have is who should own purpose and how should it be driven, you know, throughout a company. I'd be really interested to hear your views on how you think it should be.
Well, I'll go first on this one, but the whole point, I mean, what is the point? I mean, if you had a purpose statement in a company and even the 12 board members couldn't say what that statement was, then it's not really worth that much, is it? So I think we can go around houses and everything else, but there are some companies you meet, you think, you know, I was talking with Direct Line or Admiral, you know, everyone in that firm knows exactly what the purpose of that company is, and they know how to do those things. And it's not just some greenwashing or stuff like that. And they all get, even they get employee-based schemes. They get shares in the company. They feel part ownership of it. And you just feel that if I go and meet the CEO, the CFO, the company secretary, or the chairman, or any of them, I'm going to get the same kind of statement of how they feel they're going to do it. Now, they might have good times, they might have bad times. And I think what we need to get to the point of a purpose statement is just something that everyone can believe in for that company. And then you can measure that. Now, I think the FRC is doing quite a good job of trying to do it, but I think everyone should be able to put it down in a reasonably short space of time, or a short sentence or paragraph about what their purpose is. But then it should be used. If it's only used once and it's a document that's used to do, and then it's just put in the drawer, then it really wasn't worth the point of it. And I think that companies are starting to be better at that. And I think things like COVID are starting to go, you know what, I mean, I know this is only my own example, but we had a town hall on Friday with my CEO. Nigel was extremely proud of the fact that we haven't had to furlough anyone, that we've stepped up on certain different ways, that we've been looking at regional offices, we've all worked from home, we've managed to source stuff, we've helped out on all this sort of stuff. He said that's how he thought Legal and General was for the last 100 years, and it's the culture of the firm. But what has he done and how has he done it? Now, that we've always been in inclusive capital, that's one of the phrases we've used, but everyone knows that phrase, and I'm not here to talk about Legal and General, but he really is proud of how that's gone. And I think he could demonstrate that, and I think if you went and asked 2 levels down, they would give you a very similar answer, and that's really what you want.
I agree with that. Marissa, did you have anything to add, or should I go to the next?
You can go to the next question, that's fine.
Okay, super. I mean, I would agree with that, Sasha, and that's I guess the conversation we're having with lots of clients right now is how do you embed that throughout the organization? And that's about, as you said, your employees, particularly millennials that are pushing a lot of this, but there often people talk about the muddle in the middle, you know, the middle management that are tough to move on this. So lots of work to be done in terms of embedding. Now, one of the things that comes up a lot in the conversations is really in terms of reporting and getting the right information to you. There's a myriad of different frameworks and standards out there, from TCFD to SASB to SDGs, IIRC, GRI, all those buzzwords out there. And the question really is, are they important to investors? And is there any thoughts on standardization of ESG metrics from the panel? You know, is this a good direction of travel, as we've seen from WEF and other organizations trying to move to some sort of global standard? Is it helpful?
Yes. So I mean, look, if we in the olden days, when the ESG team and the sustainability teams within investment houses sat separately, we had our own data, we had our own reports, and the equity and the credit teams, they just looked at the financial data. It was a different world, different users, and we could sit there and make qualitative judgments on however companies wanted to report. We wanted it to become more integrated, and it has, but we need to understand how financial modeling works. So if you're an equity and credit analyst, if you're going to come up with a buy, hold, or sell, it's going to be premised upon a financial model, and there'll be a qualitative component to it, as we mentioned, but there will naturally be a quant data sort of element to that as well. And to have that kind of model being credible, it does require high quality data and consistent data. I mean, as Sasha talked about LNG, there's no one's going to be able to evaluate LNG if the entire insurance industry is not reporting similar metrics, because then we can have you can make an objective decision. I don't want to highlight Aviva here as well, but between the sector as a whole. But you do need that level of consistency. You do need that framework. Otherwise, fund managers will not know what to do with that data, and whatever information you're putting out there is not going to be impacting investment views in the way that you'd want. Now, investors do have a role in highlighting the standards which are of most value, and I think we should all hold our hands up, and every time there was a new standard, we thought, oh great, there's a new standard. I think we've got a role now in working through those standards and saying, look, we're going to put our hat on TCFD and SASB as an example, and I think there's movements in that way. The Investment Association are starting to vocally support one or two standards, and we think that that will hopefully materially move the dial.
So just
I'm going to answer this very quickly, but I think you'll be surprised, but SASB is getting to quite a strong viewpoint from a lot of investors as well as the Investment Association. So that would be the one that I'd think of, just in the brief interest of time. But secondly, please, corporates, you can help us as well. I mean, the amount of times I looked at retailers over the years, and they all use different churn rates, so I couldn't work out which one was people were moving on and on. They've got to standardize some of this stuff themselves and help us. If a sector came up and said, here's the way that we think we should be measured, and we're all going to do it in the same way, we'd take it, as well as we will try and work out ways of by getting all these different rating agencies and stuff.
Okay, I think that's helpful. And as you said, the Investment Association is giving some guidance on TCFD and likely SASB in the future. So it'll be interesting for that. So that's helpful. Just a couple more questions I've got from the attendees. They're coming in. One thing that we wanted to pick up on is green bonds. Will these become more commonplace, and will that be a game changer? And what are you looking for from corporates on that? Because I know there's EU taxonomy and a lot going on around this as well. Is there any views on that?
Just a brief view. They will be bigger. They will get more attention, but they're not a game changer. I think that's probably a bit too far. I think we're seeing everything. Even the government here, but certainly in the EU, are saying if you're going to get more funding, we're going to want that linked to green finance and trying to change things. So I think that's back to the social fabric. We're seeing that with the recapitalisation group, where they're trying to look at investing into the UK and then saying, if we're going to invest, we want this to be linked to something that we want to society. So I think these things are going to carry on doing that. But of course, people will want more green bonds. There's more demand from our pensioners for different kinds of products, but they have to be for the right reasons.
Okay, I've got lots of questions coming in around wider communications and engagement outside of the annual report. So just picking up on a couple that I'll just throw at you. View on virtual AGMs in the future, which I think is run by our own CEO, David Christopherson. Thank you, David. Corporate websites. How do you use corporate websites compared to annual reports to find particular information? Beyond face-to-face meetings and the annual or quarterly reporting process, what are the other primary channels that you're using to get your information and you suggest that companies should communicate through? So anything around broader communications, and I think from one of our polling questions from our last sessions, I know there is this desire for companies to communicate more continuously with investors. So do you have any views on any of those things?
I'll have a quick start. So virtual AGMs, we don't mind hybrid, where there's a virtual option, but we don't want it to be a complete substitute for physical AGMs as well. Certainly post-COVID, we think it's an important accountability tool, particularly for retail shareholders that don't have the same access to boards as institutional investors do. I think on the corporate website, we do look at it. Our starting point is always the annual report. That's the audited report. That's the one that the company has put all of their effort and they're 100% supportive of. We really look for the corporate website to provide more dynamic updates, almost as an interim from one report to the next. The final point that I mentioned is sometimes companies can report too often. And I think that was one of the problems in the midst of the crisis, that companies felt that they needed to keep giving market updates and then had to revise the update 5 days later. That actually creates more volatility, more uncertainty. So if you are trying to nurture a longer term view, it doesn't mean you only report once a year, but you can be more discerning with how often you report and what you include.
Quickly, hybrid AGMs, yes, and most investors do not want virtual AGMs. They understand it for now, of course we do, but not going forward. We want the chance, and we want the chance for any investor to come up and be able to ask a question and to be there. Quarterly reporting, a lot of companies have got rid of it. We got rid of it. Aviva got rid of it. Quite a few companies have got rid of it. We think that's too much information. It makes your time frames too short term. It's every 13 weeks. It's ridiculous to try and keep finding something to tell us about. And you come up with noise rather than anything else. And I think we need to move away from that. Corporate reporting and websites, how good would it be? I've seen a couple of examples, but not many. But how good would it be if someone on their website said, it's on page 47 of the annual report and linked it back? And I've had 4 companies who come in with the chairman who brought a slide pack in and then said, this is the data that we use in our annual report, and then brings it back to the actual consistent one page, the one that we have to do. And I think that would be the way that I want that to be used, because I think that's a really good way. And then the only other thing is we use a lot of different tools, but one of the things that we quite like is when you have a sort of ESG event or governance-y event where you invite lots of people, because we're busy just like you are, and you say, let's invite 20 or 30 of you along, and we'll go through it in a one way, and we'll talk about purpose, we'll talk about what the audit committee did, we'll talk about what the risk committee did, we'll talk about what the other committees have done, and we've got the chairs of those committees, and we do that in a 2-hour event or something like that, where we can all get there and you can hear what other people are thinking, and you can start feeling how much the company is really trying. That is a good way, rather than lots of big events. And it's not an executive event to try and sell you earnings growth. It's to talk about how you are managing the company. I think that's really useful.
Okay, all really helpful suggestions. Now, a lot of those suggestions are around how a company can control its own story, like you talked about it at the beginning, Sasha. One of the questions coming up here is how important and how much do you use alternative data sources to frame and inform your investment decisions? And then carrying on from this, which is a big source of those from Sarah Booth, is do investors think there's mileage in a standard questionnaire to assess a business? There's so many requests for questionnaires completion, whether from Dow Jones, FTSE 100, this is exhausting and costly in resourcing. That's the corporate perspective. So
I'll go first on the first question and I'll help a bit on the second if I can. But firstly, we are going to use a lot more alternative data sources. Whether you like it or not, you know, we used to have the old style way, which is still new style, but it's now becoming old style, like Glassdoor or whatever that is. But we are starting to get alternative forms. I've just mentioned, I don't even know what natural learning processing is, but I do know that people are analysing the scripts that corporates have said on the transcripts that they've been talking about in their reports, and they've been saying which CEOs are psychopaths and looking at things like that. There are unbelievable things going on in the world. Now, some of it's not useful, and some of it is, but you are going to be spotted a lot more about what is actually going on. And there's satellite data that is telling us exactly what's going on some of the pollution in certain areas that you're not picking up. And some of it should be used by the companies as well. I think companies should use alternative data than just what the executives are putting into their spreadsheets. So I think it's both, but I absolutely think alternative data is going to be much more useful. Of course, that's why I think the annual report, when you get this noise, it's a bit like the BBC when there's a real problem in the world. People go back to the news. They go back to that place. There are loads of news channels out there, but when something goes wrong, they want to know it. And I think if you've got it in your annual report, you can say, look, see, we talked about that. We've been worried about that. We couldn't get it all right, but we have tried, and give us some credit for that. And I think that's how I would look at it.
Super. Mirza, did you have anything to add to that?
I think on the index side, we're probably not the best person to ask because we don't necessarily refer too much to the likes of Dow Jones Sustainability Index and so on. I think the company needs to make a strategic decision on how they want to communicate their relative sustainability performance. They need to get a sense as to what is most meaningful amongst their broader investor base. It tends to be companies, it tends to be investors that they have the least amount of regular dialogue with, that are more dependent and reliant upon the public information that they're communicating. And therefore, it's important that you develop a strategy that you're not just talking to Sasha and I, who we're talking with your CEOs and chairman and IR people all the time anyway. How do you subsequently reach out to a broader investor base where some of those more standardized indices are more critical to how they're going to evaluate you?
Sarah, the only thing I'd say to it is, and again, I would say, there's going to be loads of surveys. What you should do is look at what your top 15 shareholders look at and how they look at your company. And they will use some of these metrics, not all of them, but they will look at it and then see where you are good and not good at. It's not that difficult to do some of that. And some of it is there's errors in the data. I've seen that many times, whether it's, you know, I won't give the name, but quite a lot of the surveys have not got, make sure your data is at least correct. But you can start winning on that because that will affect things. But then also where you don't agree with something, you don't even have to fill in the survey. You can say, we haven't filled in that survey, but this is where we think it's really important. And therefore, when you go to the investor who might think about that, and it's more the rating agencies than an index, but if they think about that, you say, but we focus on this, and therefore I can answer your question, and be forward and proactive rather than just reactive when you get asked, why have you got a poor rating on this or that?
Okay, that's super. I think I probably have time for one more question. So just in closing to both of you, what I would like you to share with the audience is what are the top things on your agenda when engaging with companies over the next few years? And how best can companies communicate on those issues to you, whether that's through the annual report or what are you actually specifically looking for in terms of communication? That would be helpful. So practical ideas here.
I think very quickly from our side, I think the conversation is evolving and moving from companies should do no evil, the Google mantra, to companies should be demonstrating the positive good that they do. I think where we're moving to is companies need to demonstrate that they are positive agents of change and appreciate that they operate within a broader ecosystem, and they have a role and responsibility in being a positive agent within that. So I mean, if we look at it within the context of climate change, if we look at it within the context of some of the social unrest that's taken place in the US, there are a greater appreciation of the institutionalized, intrinsic, widespread issues that we all have a role in playing to address. And I think some of the dialogue that we have with companies will be looking at how we can collectively work collaboratively to try and tackle some of the more systemic issues that we're facing. In terms of communication, the only thing that I would add is we would like to see consistency of messaging, whether you're talking with a sustainability analyst in a one-to-one private meeting or the CEO is standing on the stage on the Capital Markets Day. If sustainability is important for the business, then make sure that that is reflected in all communications that you have, particularly when the CEO and CFO are speaking, because they're ultimately held accountable for the future direction of the company.
All very good points. And I would say, so when I started in this role 9 years ago, the phrase that I wouldn't use, because I had to talk about money, financial materiality, I had to keep doing it in that sense, and I still care about that passionately, but the phrase I wouldn't use, which is one that we all use now, we are going to use more and more, is that companies are inextricably linked to the societies in which they operate. And that is what you're going to have to explain going forward. So the two bits that you might not be thinking about at the moment, but the one that is absolutely going to be key, not just for us, but we'll get there, is tax transparency. There is no money in the kitty anymore in government, and they've given a lot of it out, and they've done some things and some good things as well and everything else, but they are going to look at which companies have paid their fair share of tax. And I think everyone's going to be looking at that kind of area. And so you showing what you've done and everything else will be quite important. And then obviously the one that I've touched on before, but we've talked about diversity and employee rights, but ethnicity and how that is linked into that will be something that is a new area that people will absolutely ask you about. You don't have to have a perfect answer, because most people don't, but you have to have a coherent answer and one that's consistent in 2020 and in 2022.
Fab. I mean, really both great final answers. I think there's real momentum around this thinking that businesses are inextricably linked to society, which I think is a great one for companies to grapple with, how they demonstrate what they're doing against that. So on that note, I've had really good comments from the attendees saying it's been a great session. So I just wanted to thank both Sasha and Mirza and everybody for attending. I know there's been a lot of webinars lately. We didn't get to some of the questions. We'll try to get to them and answer them in a follow-up, but thank you everybody for tuning in, and keep safe and well, everybody. So thank you. Thanks, Mirza.
Thank you.
Sasha.
Thank you.